So, welcome again. Um, I am going to give everyone a minute just to drop in the chat where they're joining from and what brought you here today. What was your interest in this topic? So we'll give everyone just a couple minutes to do that, and then I'll help to funnel some of that to Janice so that I can introduce her and we can have kind of an understanding of who's here with us before we start the conversation so that it can be as interactive and applicable to your work as possible. So I'll give everyone just a couple minutes to do that. Okay, so as more folks drop in their answers, we've got someone in central Minnesota interested in environmental sustainability and local systems. And welcome Elizabeth and Mallory from Western Mass, here to learn about resources to share with the leaders of rural and small towns. Cedar Walters, West Central Minnesota, interested in the topic because they're supporting local energy initiatives, including solarized campaigns and distributed solar with community benefits. Babby, usually based in Brooklyn, big fan of the revenue-based financing model, always looking for non-extractive ways to support impactful entrepreneurs. Okay, so we'll keep having some other folks drop in as we go, but I will go ahead and introduce Janice. Janice is president of the Flexible Capital Fund, an impact-focused CDFI fund providing flexible risk capital to Vermont's food system, forestry, and clean technology business. And Janice brings economic and business development as well as financial expertise, having served in technology, financial services, higher education, and state government sectors during her more than 25-year career. Previously, she served as director of the Vermont Business Center at the University of Vermont and other places as well. So Janice, I'd love if there's anything else you'd like to, I didn't want to put too much out there, but also is there anything else relevant you'd like to share about your experience or kind of what brought you to this moment? And I'll just share too that as so often happens in rural areas, the way that this particular session came about was we bumped into each other at an event. So we were both at the Sea Change sessions in Burlington, Vermont in the fall, and bumped into each other there and was just like, oh, we need to get connected. And then when I met with her and heard about her, the way that they're approaching capital access, I was like, this is a model that we should share through our platform. So here we are. And that's what these virtual roundtables during the year are geared toward, is to be able to kind of continue to introduce new models and new ideas as the year goes on, because we can't fit everything into our annual summit. And so Janice, is there anything else you'd like to add to your bio or any questions you have before we get started?
Just that I'm a recovering ex-banker. So for those and any of the bankers around here, I've been in the business for about 12 years on the banking side. But we've been using revenue-based financing at the Flexible Capital Fund for the last 14 years. And I'm excited to say we just had our first close on our next round of capital. So we're going to keep going for hopefully another decade. So with that, I do have a presentation. So happy to share a little bit about who we are and what revenue-based financing is and why we think it's a good alternative to equity investment. And then want to make sure we have enough time for questions, because this is really more about a conversation than me spieling words at you.
That sounds perfect. Thank you, Janice. And feel free to share whenever you are ready.
Okay, so here we go. Let me find it first. All right, can everybody see the screen?
Yes.
All right, I'm going to move me over here because I'm in the way. Let's see if this works. All right, still everybody can see, correct?
Yes.
All
And
right.
you've got it in full screen mode, so
I
excellent.
did it. There we go. Perfect. So, just very quickly who we are. So, we are an impact investment fund and also what's known as a community development financial institution or a CDFI. And our mission is to create healthy food systems, preserve working lands, build resilient communities, and address climate change. And we do this by investing in companies that are providing regenerative solutions and equitable workplaces. That's a mouthful. As I mentioned, we've been around for 14 years. We are women-led and managed. We're mission-driven, but we are looking for financial returns. And, I would say at this point, we're not the only ones, but we're one of a few CDFIs in New England using revenue-based financing as an alternative to equity investment. And we started in Vermont, but we've now expanded our geographic reach to all of the rural communities throughout New England. Okay. Oops. This just gives you a sense of the types of companies that we've invested in, everything from renewable energy, solar developers to food manufacturers to forest products manufacturers, value-added agriculture. We do have an investment in Bolton Valley, which is our local community asset, a ski resort that in my mind is both a forest products company and natural resource business that serves our community well. So it gives you a sense of the types of companies that we invest in. I thought it was important to understand that as an impact investment fund, we aren't just looking for financial return. We're looking for impact, meaning what are those companies doing and how are they operating that is positively impacting the communities that they serve and the customers that they provide products and services to. So it just gives you a sense. We have some companies on the waste management side, the food waste side, keeping food waste out of the landfill and using it and putting it into the soil, making sure that their dollars are circulating locally so that they're buying local, whether it's ingredients or supplies. Are they paying full-time employees a living wage? Are they employing people in a way that where those jobs have access to grow? And are they paying in a way that's equitable? So I don't know if you've ever seen these numbers, but on average, corporate CEO pay most corporate CEOs get upwards of 200 times what their lowest paid employee gets. Ours are about 5.6 times to what their lowest employee gets. So that gap, are these are equitable workplaces. And then are they offsetting carbon emissions? And that's a really big one in terms of climate change. So just to give you a sense of what we're looking at, not just the financial return, but the impact those companies are providing. What's our value proposition? Well, for our investors, we've had a track record. We're leveraging community development financial institution or U.S. Treasury dollars to reduce our investor risk. We have ongoing cash flow. The beautiful thing about revenue-based financing versus investing in an equity structure in a company is we have ongoing revenue generated on a monthly basis versus equity where you, as an owner, have to wait for that company to sell to get your money back. We fund more sustainable companies leading to durable returns. And I think, as again mentioned, impact. And for our investors, there's oftentimes what sets us apart is we're an intermediary or a fund that has a portfolio of companies where you can spread your risk across that portfolio. For companies, the revenue-based financing is what I consider a non-extractive alternative to equity. So if we're looking for a multiple on our money that's less than angel investor is going to look for 3 to 5 times their money. So if they invest 100,000, they want to see when that company is sold $300,000 to $500,000 return on their investment. For us, if we are investing, we are looking at 1.8 to 2.2 times our money. So from a cost perspective, we're lower cost. We don't require an exit strategy, so the company doesn't have to sell in order to repay us back. We can take a longer period of time to get repaid. So that's really most early stage companies and growth stage companies in these sectors that we focus on, food and forestry and climate change. they're building a sustainable business over time. We don't need them to pay us off in 3 to 5 years like a traditional equity investor or venture capitalist. We can take 7 or 8 years for them to pay us back. We also offer business coaching and access to our network and resources. And as I mentioned before, we don't take an ownership position. We take a piece of the revenue, of the future revenue of the business. So I don't know if folks have seen this little eye chart before, but and my screen is blocking this, but this really is just what we call the capital continuum. It shows the types of capital and the types of investors and lenders and funders across that continuum, from low risk to low reward to higher risk, higher reward. And when I talk about reward, primarily cost of capital, price, right? So on your left side is the low risk, low reward. That's your banks. That's your traditional banks. For anybody who's tried to get a bank loan, they require collateral. They require that you have to have operating history. They want to make sure you got sufficient capital in the bank to be able to pay them back. They typically will ask for a personal guarantee and maybe your firstborn child, and then probably a second mortgage on your home. So banks pretty much take very little risk. They are very highly regulated, which is why they take little risk. So understanding that about a bank, but they're very important. They play a very important role in our financing system because they can be your lower cost of capital, right? If you have a piece of equipment or real estate that you need to finance, since they have that collateral, they know that there's a secondary source of repayment. So they're a very important part of the capital continuum. And kind of as you move up towards the higher risk, you've got agricultural lenders, there's lenders who are in particular market sector spaces, community lenders, revolving loan funds from economic development companies, corporations. I would give an example. In Vermont, we have the Vermont Community Loan Fund, and so they're willing to take a little more risk than a traditional bank would. They still want to see collateral, but because they're taking a little more risk, they're going to be what's called subordinated behind a traditional lender like a bank. Meaning, if you have a bank who's given you a loan and the Vermont Community Loan Fund or another community-based lender comes in, they will say, okay, we'll come in behind you so that you get first dibs on the collateral if we have to sell it to liquidate the company. But we're going to probably have a higher interest rate on that. So a little bit higher reward because they're taking more risk. So community lenders, revolving loan funds often will, or some may not require collateral. It depends on their mission and their focus, right? But they're going to be a little bit pricier, but they're a really good resource and partner for companies who are looking for debt that perhaps they can't get from a bank because they don't have operating history or they don't have as much collateral. There's also state and federal government. So in Vermont, we have the Vermont Economic Development Authority as our state lender that it will also come in with a bank to lend and provide that subordinated debt as well. Then as you move kind of in the middle, that's where we sit, right? Revenue-based financing. So essentially, that's a loan that we give to a business. And let's say it's 100,000. We're lending Juliana, you want 100,000, we're going to lend you 100,000. We're going to say we want 200,000 back in 7 years. You're repaying us based on a percentage of revenue over time. So you pay 1, 2, 3% of your gross revenue until we get to 2 times our money. So it is debt. We are getting a monthly payment, but it's not locked in like a traditional term loan is. So if you had a $100,000 loan at 8%, every month you'd have to pay us X principal and interest, whether you had revenue or not. If you don't have revenue with us, and we have a note with you, you don't have to pay us a payment because you have no revenue, no payment. Whereas a term loan, 8%, 100,000, you have to pay us whether you have revenue or not. So that's the primary function there. We don't require collateral. We don't necessarily require a personal guarantee. But if we can get that, we will, and that helps us think about what's the pricing, what's that multiple on our money, right? But we're not taking an ownership position in the business. We're not diluting ownership for an entrepreneur who doesn't want to give up ownership or decision making. You go back up, the next part of the ladder of the continuum here, convertible debt, that is still debt, but it's unsecured, meaning there's no collateral, no guarantee. But typically it converts into equity at some future date based on some future action the company takes. And typically we're going to raise a priced equity investment round, meaning we're going to raise equity investment and we're going to value our company at $1 million. And so now once we get to that next raise, I have a convertible debt note on my balance sheet. It converts to equity, and now it's no longer debt. It becomes equity, and I now have less ownership in the business as an entrepreneur than I did before that convertible debt note converted. And then the highest risk, highest reward is equity. So that's typically angel investors, which are individuals, high net worth individuals who invest directly into businesses or venture capital funds who pool money from limited partners and then invest in businesses. And typically that money has higher expectations of growth and of margins and of ownership, right? So they're going to take an ownership position based on the value of the company. They're going to expect that company to grow year over year, 30, 40, 50%, et cetera. And they're going to expect an exit strategy, meaning the company either has to sell or merge in order to get their money back. And they're looking for that 5 to 10 times their money. So higher cost, higher reward, taking more risk though, right? For many companies that don't have revenue yet, or that have a path to revenue that really are growing fast, and can't have a regular principal and interest payment or even a revenue share payment on their books because they can't support that. This is high growth money, right? And it's, again, there's no good or bad money on the continuum. We need it all. And oftentimes that you need to work in combination with debt and equity and revenue-based financing. One thing I will say is don't overlook grants and program-related investments because that is, again, a source of capital. So grants, oftentimes there are philanthropic organizations that provide grants to for-profit entities. And then program-related investments would be a foundation of philanthropic organization who's not making a grant, but actually investing in the company, whether that's a loan, a revenue-based financing note, or an equity investment. So there are foundations that will do program-related investments in combination with their grant making to fulfill their mission. So why is it so hard to raise capital sometimes as an entrepreneur? Well, we've talked about some of these things. Lack of collateral. You don't have hard assets. It's too risky if you're an early stage company trying to grow. You don't have enough operating history, or going to a traditional bank that doesn't understand renewable energy or doesn't understand manufacturing. If they don't understand your industry, they don't always have time to get up to speed on it, and so it's easier to say no, right? Equity. Well, equity, again, is getting equity investment from an angel investor or venture capitalist. You really have to be in that, I need jet fuel, I don't need auto fuel. You need to be really taking off and going fast and big. So you need to have a high enough growth rate. Equity is hard to get if you don't have an exit plan. Those equity investors want to understand, are you going to sell the business in 5 years? If you don't want to give up decision-making or control, typically an equity investor will have a seat on the board or have some vote in how the business moves forward. Maybe your market isn't large enough to attract equity investment, or you need more time to improve your valuation. So that's the value of the company. So what is revenue-based financing? So again, it's debt that can act like equity. We take a percentage of revenue over time, not a percentage of ownership. It's structured over a fixed time period or until we get a set return, 1.8, 2 times our money. It is less expensive than equity, but it's not low cost capital. So let's be clear. This is not 3% debt that's amortized over 10 years. It is flexible risk capital, so it's going to be priced that way. We don't force an exit strategy, and it's one more option out there. And it's a good fit, I think, for companies that are maybe turned down by banks because they've had a hiccup in their sales or profitability. They don't have enough collateral. Maybe there's a concentration of sales or market interruption, or the entrepreneur doesn't really have any assets to personally guarantee the note. And it's a good fit when companies can't or can't get or often don't want, just flat out don't want equity because they don't have an exit plan. They like being, the 100% owner of the business. They're never going to be a high enough growth or margin to attract that kind of equity. They want to keep their freedom and control, and the existing capital structure maybe doesn't fit for them. So here's an example. I'll give you a little case study. This is one of the early companies that we invested in. At the time, it was called Northern Reliability. It's now known as Core Power. It's based in Waterbury, Vermont, a rural community. And they came to us early on, in their business life cycle. They're a renewable energy battery storage company, and they had growing pains. Lumpy revenues. They were more project-based than product-based at the time. So, they have 3 months of revenues and then nothing for 3 months. And so to be tied into a term note was going to be very difficult for them to service that debt. They needed working capital to grow because they did have pipeline. They had opportunity, and they needed to seize the market opportunity in energy storage. Now, this was in 2016. Fast forward 2026. What's the key to renewable energy projects? Storage, right? So they are flat in the right space, getting there at the right time, but didn't have the working capital to hire the people and do the sales and marketing that they needed. And they couldn't get bank debt because they didn't have any operating history that was profitable. And equity was off the table because at the time, the company at best might have been valued at, $1 million. And that they weren't willing to give up that much ownership in the business. So we came in with a revenue-based financing note. It was $450,000. And in the beginning, they had 6 months of no payments, and then they paid 2% or 2.4% of gross revenues on a monthly basis. By the time they got to our multiple, which was 1.9 times our investment, that it was 7 years later, and they were fully paid off. So we took a bet that business was going to grow and grow sufficiently in a way to get us paid off in that 7-year time frame. And again, our multiple was less than what an angel or a venture capital fund would be expecting, and it provided them breathing room to grow. So fast forward, they merged with a company called Core Power in 2022. They went from having 25 employees when we originally started to, I think they're probably upwards of 100 now in Waterbury, Vermont. They remain in Vermont, providing good paying jobs, and they continue to innovate in the mobile energy storage space. They spun off another company called Nomad Transportation Systems. And so in addition to the revenue-based financing note that we had what are known as warrants. So we had the right to invest equity down the road, which we did when they merged with Core. So we remain an equity investor in Core and their offshoot of the company Nomad. But we've since been fully paid off on their revenue-based financing note. But the bottom line on this case study was that they needed working capital to hire people that they just couldn't find anywhere else. And oftentimes that's what happens. We come in when I don't want to say nobody else wants to, but we see the opportunity and we look ahead at what the company's possibilities are versus looking in the past. And traditional lenders are looking at the historical performance. We're looking at the future performance of the business. So this is just a little commercial from my friend Jay Bellows, just telling folks that we were instrumental in helping them move this company forward. So here's the benefits. Again, I think I don't want to beat this to the ground, but we think it fuels more sustainable companies because we're not forcing an exit and forcing them to grow exponentially. It's adaptable to economic cycles. Think about the pandemic. When the pandemic happened, and a lot of our food companies that were selling to restaurants had no revenue the next day. We didn't, there was no default in the note. They didn't have revenue, they didn't have to pay. It supports resilient companies, companies that are doing this hard work of mitigating climate change and building more resilient communities. And for us, we think it's aligned and it aligns the incentives of the borrower and the investor. So it's a win-win for both. Self-liquidating, like I said, doesn't require an exit, and it's lower expectations of returns than equity. And again, equity, I'm not saying equity is bad. I'm just saying equity is different and we need it all. But traditional equity definitely is for the high growth companies that are on a very fast trajectory. They call them unicorns, right? And it requires continued growth that isn't always sustainable. It's illiquid. You have to have an exit, dilution of ownership, and it's less available to sustainable impact businesses, which is our focus. And that's all we got. So I'm going to stop there. And do we have time for questions?
Yes, we do. We've got 30 minutes, so we have time for discussion for sure. Thank you for that, Janice. That was really helpful. And I also found myself, even as a nonprofit executive director, this isn't a for-profit business, but just that patience and that the long-term thinking I can appreciate even from a nonprofit perspective, because I think anyone who's worked in nonprofits knows that it's hard when a grantor has an expectation that a program or something is going to be self-sustainable within 2 years or even 3 years. And sometimes it just takes longer than that to get going. And so I think that really resonated with me. So I would love to open it up for questions at this point, and anyone can either raise your Zoom hand or your physical hand. And that way we have, if you click the Zoom hand too, we can have an order of who has questions too. And speaking of patience, I'm very patient, so I can be quiet for a while. Just give those who might be a little shyer some time to speak up. Yeah, Richard.
Yeah, Janice, I have a couple of questions. One is, who are your investors? Are they institutions? Are they individuals? Or are they sometimes banks or other kinds of lenders?
You want me to start with that?
Yeah.
Happy to address that. So in our first launch, which was back in 2011, and it's similar today as well, we, as a mission-based, impact-focused fund, wanted to make sure that the investors that we took capital from were in alignment with our mission and values, because that money needed to be patient and being willing to take risk going out to our company. So the kind of money that we raised coming in dictated how flexible and how much risk we could take going out. So we spun out of a nonprofit organization called the Vermont Sustainable Jobs Fund. We are a for-profit entity, but we still are in alignment with those values of impact first. And so we have relationships with philanthropic organizations. So, and I'm sure they have no issue with me talking about their work. The Vermont Community Foundation is one of our larger investors and one of our first investors who saw the value in moving beyond grant making to do a program related investment in the Flexible Capital Fund. And they liked the idea that we were doing the diligence, that we were managing the portfolio, because they're not equipped to do that. So it's a good fit for a philanthropic organization to be invested in intermediaries that can then do that work that they perhaps don't have the capacity to do. So philanthropic organizations like the Vermont Community Foundation, we work with a lot of asset managers who have clients who individual clients who are high net worth individuals who want to invest in their local communities and looking for ways to do that. So we started out in Vermont, we're now investing in New England, but we're still part of a regional community, right? Forests our northern forest is regional, our food system is regional, our energy system is regional. So we see the value in engaging regional investors so that we can invest capital going out to the region. So high net worth individuals, philanthropic organizations, we've had a few for-profit entities. We've talked to banks. Banks are not as willing to take the kind of risk. Banks do a lot with CDFIs, and we're a CDFI, but we're unique because we also do not just revenue-based financing, but we'll do some smaller equity investments when we know there's a self-liquidating strategy at the end of the time. So we're riskier probably than a lot of banks would be interested in. So we haven't spent a lot of time looking at banks as an investor, but certainly, that is an area you could be looking for if you're looking to raise a fund. So, and now this second round, we just had our first close and we're continuing to raise capital. We still are similar profile in terms of high net worth individuals, accredited investors who are interested in the work that we're doing regionally around food systems and climate change. And philanthropic organizations. I'm excited to say we actually have the three Northern New England community foundations supporting us this time around, which is great because typically you stay in your box, Vermont, New Hampshire, Maine. But I think there's a recognition that we need to be working together, especially in this time and day. So
That's great. Just as a follow-up, is there a minimum investment to go into the fund if you're an individual investor or?
yeah, it's 50,000 for individuals, 100 for institution.
Okay. And then a different question, just when you're taking warrants, does your return include exercising the warrants or the warrants for that return?
No.
Okay.
No, the warrants, we'll take warrants if it's the kind of company like Northern Reliability that merged with Core that has a real opportunity to grow and that they are going to need to raise equity down the road because that's just their growth trajectory, right? And so we took warrants there, never expecting to actually exercise the warrants, never expecting to have equity. But it just happened they had a really great opportunity, and knock on wood, we'll hopefully get some return on that. If we don't, it doesn't matter because we've gotten our return through our revenue-based financing note.
Great, thank you.
Thank you. And Richard, I saw in the chat that you're new to Keene, so come by the Hannah Grimes Center and we'd love to get to know you.
Okay, great. Thank you.
And I'm really glad, Janice, that you brought up the regional approach, and Lily knows that I'm not going to shy away from an opportunity to just plus one that that working regionally is so essential. And I also oftentimes like reference the idea of bioregionalism and really how you can't just take care of your one section of the river and think like you've done it. The river is connected. So our watersheds, like you said, and our forests and we need to be working regionally. So thank you. And I support.
Absolutely.
So Charles was next. And then if anyone else has a question, you can either raise your Zoom hand or just raise your hand after Charles.
Hello, Shaka.
Hey, Janice.
He's done some RBF notes too, so he can hopefully add to what I had to say.
Yeah, well, I'm just really glad to make this talk. I'm always loath to miss one of your talks because there's so much to learn from you. And so I just wanted to ask for your latest thoughts on managing these types of instruments on the administrative side, like operationally, when you have a lot of them and they do have some complexities, is it something you just put into Excel, or are there third parties out there that can manage the administrative side for you? I know most of the platforms I've tested, the third party platforms have term loans, but they don't necessarily have revenue notes built in. So just wondering about your thoughts on that. and
Yeah, and I'm
suggestions.
happy to have a separate conversation to Shaka down the road about how we managed over the last 14 years. It's I have a finance manager or during the first fund that was very patient with me because we were learning as we went on how to actually do the accounting, the back end administrative work around these types of notes because it's a no interest loan, and I think that's the key right there. Is as you can't have a no interest loan when you're doing any kind of gap accounting. And I won't get into accounting, that's nerdy stuff, but point being that you have to impute a rate, so to speak, in order to account for principal and interest to show how the note is amortizing over time when you're doing your financial statements for your investors or your tax returns for the IRS, right? So we learned as we went. We did most of it in Excel that the first time around. We are now working with a fund administrator called Broad Street Impact Services, which is a B Corp, and hopefully that will be a little more efficient than what we were doing. But yeah, it's fun. It's not really. I'm just kidding. It's work to try and manage and administer the back end financial piece of it, but it's absolutely doable. So,
Okay, thank you.
All right, Alex.
hey,
Yeah,
Alex,
thanks. Hey, Janice, good to see you. And
you too.
similar to Charles, I'm also loath to miss an opportunity to hear and learn from Janice. I've known Janice for many years and would be really curious, Janice, to hear sort of the latest and greatest from you in FlexCap Fund in terms of how you think about impact covenants and also managing impact reporting from an administrative and storytelling point of view.
Sure. So covenants, I think we start by we do due diligence versus underwriting our loans. So underwriting for a traditional lender is looking back at history and financial statements and collateral. We we do due diligence looking ahead, so really getting to know and understand the business and what they're tracking, what they're not tracking from an impact perspective, right? And how are they telling their story? So we have a good sense of the things that they're tracking. It is really hard to get that information from earlier stage companies that haven't really thought about that or don't have the capital to put systems in place to actually measure that impact. So we do an annual impact report. We have a consultant that helps us with that. So this is the fundamentals that we ask every company to track. Revenue growth, obviously financial side of things. Looking at assets and capital raised, but job creation, and then are you paying living wage jobs? So those we're asking them to track. What's the diversity in your management team, on your governance board, on your advisory board, those types of things. So those are the fundamentals. We do have a diversity, equity, and inclusion rider in our notes that we ask every business that we're working with to have a policy in place and to also look at if they're interviewing for a leadership or management team position, making sure that they're putting that out to a diverse community, that they're interviewing at least, 2 or 3 diverse candidates, that they're making that effort. It's an interesting time right now that we sit in where those things are being dismantled and publicly, you're not supposed to use that language. We haven't changed our language. We haven't changed our language around climate change. We're so far under the radar, and maybe that won't be the case now, but it's really important to maintain our belief in a mission and values around the work that we're doing. So it is important. We look at the diversity of the team before we even decide to invest. And it's not saying we wouldn't invest in all white male team, but we'd have to know that there's a willingness and an ability to diversify, because we know the data is there. The data behind a more diverse governance team, a more diverse leadership team leads to better financial results. That's the data. And gender, race, ethnicity, what have you. So it's an important component for success for our businesses to have that. So we do have that rider. We do an annual impact report. We collect the data, and we can provide general information about what the impact our businesses have had over that year and over time. But it's not a precise science, because everybody has different reporting ability, and both on the capacity as well as the dollar ability to support systems like that.
Thanks, Janice. Yeah, really interesting to hear you articulate the difference between underwriting, sort of backwards looking, and due diligence forward looking. I've never heard it put quite like that, but that's helpful. And the DEI rider, and it's great to hear your approach. Thank you.
And, you think of, there's that sort of concept of trust being a key factor in
number one. It's the number one. You have to, we are building relationships with our entrepreneurs. It's, anytime you take on other people's money, I don't care what kind it is, it's you're in a marriage.
Yeah.
Right. And it's ugly when you have to go through a divorce. And so you want people who are going to come to you not only when good things are happening, but when bad things are happening, and before it's too late. So we do have observer rights on all the governance and advisory boards that our companies have. Not every company has a governance board or an advisory board, but when they do, we ask for observer rights, because we want to be a partner. We don't have decision-making authority, but we can see what's happening at that level and can help offer resources and access to our networks.
Awesome. Thank you. And Lauren, I didn't see any notes in the chat. Where are you joining from? And come on in.
Hi, I'm joining from Central Texas. Also, I'm a lawyer by trade. Appreciate that marriage divorce analogy to lending. I often use that also with folks to say, this is more about trust than the numbers. I'm a former grass-fed beef producer and now executive director at Food System 6. We work on developing credit enhancements exclusively for regenerative, sustainable, organic agriculture to complement how producers are often eliminated from federal farm safety net programs when they do transition. I'm curious, Janice, about whether you saw any ripple effects out of the mass cut of federal funding. A lot of these grants, like value-added producer grants, equipment purchasing grants, from what we understood, lenders really like to see those as part of the cash flow and accounts receivable. And we heard a lot of anecdotal evidence about people losing their loans or having their loans called on early, or just a really negative impact from losing a lot of access to that grant capital. So just curious, within your food and ag lending portfolio, if you saw anything like that, saw any ripple effects, have seen any solutions. And for context, I asked this because we run a loan guarantee fund, and we've been trying to see, could we perhaps put guarantees on existing lines of federal payments to really incentivize lenders to still go forward with a bridge loan or something to that effect?
Yeah, no, I mean, we don't have any in our portfolio currently that's been an issue, but I am part of a broader network of what's called New England Feeding New England, and then also the Farm to Plate Network in Vermont. And so from a value-added producer and infrastructure perspective, yes, those monies going away have been devastating to some of the larger players in the region, right? And that then impacts the manufacturers and the folks who are using those ingredients to then create their own products. So I would say it's that in combination with just the cautiousness that I'm seeing happening in the lending arena because of everything that's happening. So it's not just the money going away, it's the environment, it's the perspective, it's interest rates, it's chaos. It's a really challenging time for businesses, especially in food systems that are doing this work, that are taking longer to get off the runway and grow. So anything that you can do to support those folks, especially the CDFI world, who are, a little bit less cautious than the banks in providing some kind of backup or guarantee, because the CDFI fund in itself has been devastated. I just saw that there is an appropriation for 2026, which is great, but it's not what it used to be, and it's not the backup capital that they need to then support the businesses that you're talking about. So, that I think more and more loan guarantee money will be, if it can be structured right, will be a really good tool to support some of these projects moving ahead. But I also think, I would love to see more philanthropic organizations step up to the plate with investments, not just grant dollars.
That's super helpful. Thank you. We are approaching philanthropies for unfunded guarantee commitments leveraged against their endowments. So hoping to activate some endowment capital, but just appreciate the comments. That's helpful. Thank you.
Yeah.
Great. Other questions? Okay. Janice, is there any, we have some links we want to share in the chat, both for your Flex Capital Fund and then also for 2 upcoming virtual roundtables we have in March. One is for our, about rural areas what they need to know about AI data centers. And then also one where we're doing sort of a collaborative process of helping to co-create our next summit. So we'll drop the links in there. And is there any final thoughts that you have, Janice, or anything else you'd like to add?
I would say we're in a very challenging time right now for companies raising capital, especially in those market sectors that we are trying to really make change in, with food and forest products, natural resource sectors, and clean energy companies. So the more we can be creative with our instruments, and I talk about, there's risk, the word risk as a noun, which means danger. And there's risk as a verb, which means to be brave, right? And so I want us to think more in alignment with, let's be more brave with our money, because that's what's needed in this world right now. We need brave capital to step up and take on the challenges that we're facing as a region, as a nation, as a community, a world community, right? And so, it goes back to how much is enough. When you got enough, then take some of that and let's be brave with that money. So that would be my one ask of folks who have capital, who have the resources. Be brave with it right now. That's what we need. And I'm going to put in the chat also for folks who want to learn more about the various kinds of financing instruments. There's a really good website called the Innovative Finance Playbook that was done in part by Annie Patton Power, who wrote a book called, where's her book? Adventure Finance. So I love that word, adventure finance. Great book, but this is a really great resource for entrepreneurs and for investors who are looking to figure out, okay, how do we do things a little bit differently? How do we look at combining, structuring an instrument that I can get my money back from, that's creative, that fits the needs of the business and fits my needs. And so there's all kinds of case studies and templates and all good stuff there.
Janice, that was a beautiful way to end this. And we as an organization and in our Radically Rural programming have been sitting in very similar spaces. We have an updated strategic framework we're working on finalizing that will ideally be voted in March. And so we've been sitting a lot with concepts like bravery and what that looks like. And then also sitting, because we're going to announce our Radically Rural registration on Friday and the theme, and I'll just say it fits perfectly with what you're describing, that we're talking about both using the creativity and tools that we have in the world that it exists as of now, which is kind of, what this has been about. What tools and models can we use in the world as it is now, and also imagining the world as it could be, and that we hope it is, and how we can orient ourselves in stepping forward in that. So, Katya, did you have some final thoughts as well?
Sorry, I just had one final question for people outside of this investment finance circle. I was just so curious, do you feel like you're alone and pioneering in this work as Flex Capital Fund, or is there a growing movement like that you're tapped into both nationally, maybe regionally, and globally? I'm just so curious, like from the outside in, how that feels.
Are you talking to me or to
Yeah,
other folks?
to you,
Oh,
Janice.
no, no, no. I do not feel alone because I mean, I look at Alex, I look at Shaka. They've been in this space, and we're all learning together. But I think more and more there's a recognition that equity investment is just. I mean, it's a fit for 3 to 5% of all the businesses out there, right? And what happens to the other 95% of businesses that need patient high risk capital. And so revenue-based financing is finally coming into view as an instrument that could support that. I don't feel alone as I used to. And so, I wish there were more community development financial institutions, CDFIs, who have in the past had access to Treasury dollars to be able to take on this risk so we could do it in partnership with them. But we do have partners. New Hampshire Community Loan Fund has been great. Coastal Enterprises up in Maine has been partners with us in some of our RBF notes. So they're learning as they go, and we're doing this together. And that's what we need. We just need more people to understand how it works and how we can facilitate more of that kind of capital getting out there.
Awesome. I saw one person come on video. Did that person have a question, or are you just saying hi? Okay. All right, great. So thank you so much, everyone. We're giving you 5 minutes back in your day. That is our gift to you, and we hope to see you around virtually or in person. Thank you, Janice.
Thanks so much for the opportunity. Have a
Thank
great day,
you.
everybody.
Bye.
Bye.